Hey guys, Rafi here from the End Game Investor, and something big is happening in Japan. It is caught between a rock and a hard place, and as a result of that trap, US Treasuries are going to get squeezed. We're already seeing it in the markets. In the 10-year, interest rates are back up to 3.15%. The 2018 high is 3.24%. Once we hit and exceed that line, could be a whole bunch of sell stops on US Treasuries, forcing the Fed to buy it all and go back to loosening monetary policy after just, what was it, half a basis point hike? Who knows? We'll see. Here is the rock, and here is the hard place, and here is why US Treasuries are going to get squeezed, and then we could be in a late 1970s scenario where long-term interest rates head higher and higher along with gold as the entire fiat currency system collapses into oblivion. You know, all the Keynesian fetishists and fanboys who don't understand what common sense is, and they point to Japan and say, look, you can print money forever and there'll never be any inflation. And there's just a fountain of youth and money printing and everything is fine. It will be fine forever. You don't have to ever worry about making a living again. Well, that myth is going to come crashing down sooner or later, possibly sooner now. It is not going to sustain itself because Japan does not live in an alternate reality, Garden of Eden, fountain of youth, where there is no mortality and interest rates can stay negative forever. Japan, contrary to popular belief, is full of mortals. Here we have from the FT, Exhibit 1, Japanese finance officials make rare statement on yen's decline. BOJ's, Bank of Japan's ultra-loose policy has set it apart from other major central banks this year. Yeah, because they cannot afford, under any circumstances, to raise interest rates because their debt to GDP is something like 270%. The article begins. The yen stabilized on Friday after 5 straight days of declines, as Japanese authorities expressed concerns over the sharpness of the currency's recent fall in a rare joint statement. The missive from the Bank of Japan, the Ministry of Finance, and the Financial Services Agency follows an unusually fierce yen sell-off over the past few months that has taken the currency down 14% since early January towards a 24-year low, ripping it out of its 6-year trading band. Here's the actual statement from the Bank of Japan, translated by Google Translate. Statement of Information Exchange Meeting on International Financial and Capital Markets, Reiwa, June 10-4, whatever that means. Here are the bullet points. It is important for the exchange rate to remain stable along the fundamentals, and rapid fluctuations are not desirable. In the recent foreign exchange market, we are worried about the rapid depreciation of the yen. The government and the Bank of Japan will work closely with each other. That's beautiful. Kumbaya, to closely monitor the trends in the foreign exchange market and their impact on the economy and prices with even greater attention. Bullet point 4, regarding foreign exchange policy, based on the idea agreed in the G7, etc., that excessive fluctuations and chaotic movements can adversely affect the economic and financial stability while maintaining close communication with the currency authorities of each country. Take appropriate action if necessary. That is all. It even says that. See here. That's all.
That's all, folks.
This is the Japanese government bond yield, 10-year. You see here, this line at 0.25 has been hit 1, 2, 3, 4 times since March. That's interest rates trying to go up, meaning market players are selling their Japanese government bonds, and who is buying them at 25 basis points? The Bank of Japan. This is from a March 30th article where the Bank of Japan decided it was going to intervene in the bond markets to pin Japanese government bonds down at 25 basis points. The move, it says, bolsters the BOJ's intervention in the bond market announced on Monday, in which it pledged to buy unlimited amounts of 10-year government bonds at 25 basis points until Thursday. And it's still doing this because otherwise this wouldn't be hit so many times and then turned back down. They're still buying at 25 basis points. That's the rock. Here's the hard place. The hard place is the yen. We see here that the yen has been collapsing against the US dollar. The higher this goes, the lower the yen is in dollar terms. And we see we are at the 2002 final support here at 134. This here is the 1998 Asian financial crisis lows in the yen. Once the yen starts falling against the dollar like this, you're going to really start seeing Japanese consumer price inflation, especially because they do not produce any oil and they import it all. And so, given the rock and the hard place that the Japanese bank, the Bank of Japan and the government of Japan have issued statements saying they are going to intervene in the currency markets, but they will not hike interest rates because it is impossible and because they will keep them pinned at 25 basis points. How the hell are they going to strengthen the yen by intervening in the currency markets? And the answer is, when you're trying to strengthen your currency, all you do is you sell foreign currency. And what is the largest foreign holder of US Treasuries in the world? It is not China. It is, in fact, Japan. This is the tick data. Treasury International Capital keeps track of foreign ownership of US Treasuries. Number one, March 2022, is Japan, $1.2324 trillion in US Treasuries. This is a big fall from February 2022's number of 1.306 trillion. I think it's a fall of about 2.5%, something like that. They're already selling. And when they sell, how does that support a currency? Well, when you sell US Treasuries, you get dollars for them. And the dollars they will have to sell. But what are they going to buy? They could buy two things. They could either buy commodities or they could buy yen. If they buy yen, that means they decrease the money supply, which is going to squeeze the Japanese economy. Or alternatively, they could buy gold and back the yen with that. Who knows what they will buy, but the point is they will be selling US Treasuries, and they are the largest holder of US Treasuries. They will get dollars for them, and they are going to buy something with those dollars. Because the point is not to sell US Treasuries, it's to sell dollars, and the way they get dollars is by selling these US Treasuries first. And so what we are likely to see from here on out is rising interest rates, because as Japan sells their stock of treasuries, it's going to prompt other countries to sell their stock of treasuries too, because it will push prices down. And nobody is going to buy this stuff with the Fed on a hike path, because when the Federal Reserve hikes, the value of bonds go down. And since people understand that the Fed cannot stop hiking without destroying the dollar, since inflation, consumer price inflation, is still on the rise, despite all the transitory nonsense, nobody's going to buy these bonds but the Federal Reserve, which means that the Fed is going to be forced back on a money printing path to absorb this selling. We are in a 1970s scenario, basically. Rising interest rates, falling dollar, rising commodities, and gold and silver will lead. Exactly how late in the 70s are we? 1977, 1978, 1979? I don't know. But there's one big difference between now and the late 1970s, and that is the debt is orders of magnitude higher than it was back then. Japan can either sell US Treasuries or watch the yen collapse and Japan fall into a hyperinflationary abyss, as they did in the early 1970s. As Japan sells, other countries are going to follow, and a whole bunch of treasuries are going to come back to the United States. If the Fed does not buy them, interest rates will go up spectacularly. And if the Fed does buy them, interest rates will go up more slowly, but the dollar will go down much, much faster. We're reaching the end of this game. It might not look like it from gold and silver's action, but to close out the week, we did see a collapse in US equities, especially tech, and a rise in gold and silver stocks. That's just one day. There have been fake outs before, but one of these days, it's not going to be a fake out. It's just going to keep going and going and going. This is Rafi of the Endgame Investor. If you like this video, consider subscribing for a 2-week free trial of the Endgame Investor. Link in the description below, or become my patron on Patreon, where you will get a weekly video on monetary policy from a biblical perspective. Sounds strange? It is. But if you're into that stuff, you'll probably like it.